Welcome to the Pro Ticker Deep Dive.
Great to be here.
Today, we are jumping into a massive, and I mean almost invisible transformation that's happening across the entire U.S. economy. We're talking about heavy infrastructure construction.
Right.
And this is a multi-trillion-dollar opportunity that I think very few people really grasp the scale of.
That's exactly right. I mean, if you just look at the raw numbers, the U.S. has this, just staggering investment gap.
Just to get things back to normal.
Just to bring existing infrastructure up to par, we need something like $9.1 trillion in repairs and upgrades through 2033. But the planned spending leaves an estimated deficit of $3.7 trillion.
Wow.
And that deficit, that gap, is the foundational need that's driving everything we're seeing today.
And what's so fascinating to me is how that gap is being filled.
Yeah.
It feels like it's happening almost simultaneously from two enormous sources of capital.
Yep.
You've got the public sector side, right? Driven by the $1.2 trillion Infrastructure Act, the IIJA, and all those clean energy incentives from the Inflation Reduction Act, the IRA.
That's the federal push.
But then you have this other side.
Well, the real kicker, I think, the force that really makes it exponential is the private capital. It's just flooding into AI and data centers.
Yes.
That explosive, insatiable demand for new computing power is just hyper-accelerating construction, and the public funding helps enable it.
So together, those two forces are targeting, what, a roughly $7.4 trillion opportunity.
That's the ballpark, yeah.
Okay, so our mission today is to unpack exactly how two specialized heavy construction giants, MasTec and EMCOR, are capturing this infrastructure bonanza.
And while they're both wildly successful, their strategies, their risk profiles, and their market valuations, they diverge pretty dramatically.
We're really witnessing a genuine construction renaissance here. It's driven by these undeniable secular tailwinds, fiber deployment, grid modernization, renewables, and of course the AI data center gold rush.
And we need to understand how these companies capitalize at different points in that whole value chain.
So let's start there. The sheer scale of the need and the money flowing in, because this isn't just talk anymore, the money is actually moving.
Precisely. That's the key. The IIJA committed over $1 trillion over 10 years. And look at the data proving it's happening.
Okay.
By late 2024, almost 47% of all IIJA funds had been allocated to over 68,000 projects. We're talking transportation, water, broadband.
So the mobilization phase is over.
It's done. The execution phase is in full swing now, and that creates guaranteed long-term revenue for these firms.
But as you said, federal money is only half the story. The real macro driver, the thing that turns this into a generational boom, is the data center infrastructure.
That is the critical insight. This is the difference between, replacing old bridges and building the entire new digital foundation of the economy.
So give me a number that puts that into perspective.
Okay, consider this one specific, absolutely mind-boggling number. The world is projected to spend $580 billion on data centers in 2025 alone.
$580 billion.
Yes. And to frame that, that is $40 billion more than will be spent globally trying to find new oil supplies this year.
Wow. Okay, that really grounds the scale of this.
Data centers have structurally become the single largest capex driver on the planet. They've surpassed traditional energy.
And that build-out, it creates this mandatory cascading demand effect, right?
Domino effect, exactly.
An AI data center needs massive guaranteed power. Hundreds of megawatts. So that forces the construction of new solar farms, battery storage.
Major grid interconnection upgrades, new high-voltage transmission lines to even carry the power. And of course, none of it works without ultra-high-speed fiber networks.
So when we look at a MasTec or an EMCOR, they're not just selling like commodity construction.
Not at all. They are highly specialized engineering firms sitting at multiple required high margin points in this entire AI-driven utility chain.
Okay, so let's dig into the first one. Let's start with MasTec, ticker MTZ. It's got about a $15.1 billion market cap, and you called it the diversified infrastructure workhorse. So if you want broad exposure, MasTec is your proxy.
It's a great proxy. It's diversified across three main sectors. You have communication, so think fiber and 5G deployment. Then you've got oil and gas pipeline construction.
Okay.
And then clean energy and infrastructure, which handles all the renewables, grid upgrades, and that heavy civil work.
And their recent Q3 2025 results, they show the intensity of this demand. They reported revenues of $3.97 billion. That's up 22% year over year.
Which is huge growth. But even more impressively, their backlog hit a record $16.78 billion.
16. That is multi-year revenue visibility well into 2027.
Absolutely. And the specific drivers really highlight these secular trends we've been talking about. Communications revenue surged almost 33% year over year.
And what's behind that?
It's heavily driven by fiber deployments. You think of companies like AT&T, which is publicly committed to doubling its fiber passings to 60 million locations by 2030. That's a stable 5-year work mandate from MasTec.
And the diversification shows up too, right? In the pipeline segment.
It does. Its backlog more than doubled year over year. And that's not just traditional gas work. It's reflecting emerging demand from things like carbon capture and sequestration projects, CCS. So the growth potential is definitely there.
Yep. And here's the twist. Here's where the rubber meets the road. Despite beating on revenue and earnings, the stock actually fell 2.3% after they reported.
Yeah, the market hammered them, and it was all about execution and scaling difficulties.
So what was the anxiety about? What went wrong?
Well, they cited margin compression in that pipeline segment, said it was due to volatility and project mix, so some efficiency issues. But the big one, the most significant problem, was permitting delays on major transmission projects.
Bureaucracy.
They specifically mentioned the Greenlink project. So, government capital is great, but that bureaucratic friction is still fierce.
And I saw their free cash flow decline sharply too.
Critically, yes. Because when you land a massive, $17 billion backlog, you have to ramp up your working capital immediately. You're hiring labor, buying materials and equipment, all long before the government actually pays the milestones.
So scaling fast is just incredibly expensive.
It is, and it carries significant financial risks.
And I guess this execution friction is the key to understanding its valuation. MasTec trades at a PE ratio of 35.67.
Yeah.
For a construction company, even a specialized one, that PE is pricing them like a growth tech firm.
Exactly. Not a firm that's exposed to concrete and weather and permitting risks. So any minor delay, any little bit of margin softness, and it justifies a pretty significant correction, which is exactly what we saw happen.
So it's the cost of that diversification. They touch every part of the story, but that breadth introduces a volatility that a more focused player avoids.
Well said.
Which brings us perfectly to EMCR, ticker EME. This company, larger market cap, $26.1 billion. It operates, as you put it, like a surgical scalpel.
That is the core contrast. EMCOR specializes in the complex, highly refined systems that are required inside these next-gen data centers.
So not the concrete shell.
Not the shell, the guts, the mechanical, electrical, plumbing, HVAC, fire safety systems. These are not just high-value jobs. They are bespoke, mission-critical environments where installation precision commands a premium price.
And their performance seems to reflect that profitable focus. Q3 2025 revenues hit $4.30 billion, up over 16% year over year.
And they hit a record $12.61 billion in remaining performance obligations, it's essentially their future sales backlog.
And the concentration in that backlog is what makes them a pure play on AI.
A pure play. A massive $3.8 billion of that backlog is directly from data center projects. And EMCR estimates that 85% of their network and communications work is now tied directly to data center construction.
So they've made themselves indispensable to the hyperscalers.
Completely. A high-margin, indispensable subcontractor. And because they're specializing in those high-value systems, the things that make the data center actually work, their margins are expanding.
That expertise gives them a pretty strong competitive moat.
It really does. Their 2025 EPS guidance was narrowed to a very robust $25 to $25.75, which implies, strong 16% year-over-year growth that seems a lot more certain than MasTec's volatile pipeline segment.
And they're making strategic moves, too. They're acquiring capability.
Right. They're not trying to build it from scratch in this labor environment. Their acquisition of Miller Electric earlier this year was a really calculated bolt-on to deepen their specialty in large-scale electrical infrastructure.
And we shouldn't overlook the technical market moves. EMCOR was added to the S&P 500 in September.
Which is huge.
That seems like a small detail, but it forces all those large institutional index funds to buy and hold the stock.
Right, and it adds this layer of passive stability and support that a stock like MasTec just doesn't have right now.
And the market sees that stability. Its PE ratio is significantly lower, at 23.47 compared to MasTec's 45.
It's still a high multiple for a construction firm, but the market views EMCR as a much more mature, disciplined operator that's focused squarely on the most profitable niche of this entire boom.
So zooming out,
Right.
we have the diversified workhorse and the focused scalpel, both riding the same multi-trillion-dollar wave. What's the fundamental trade-off here for someone looking at this space?
Well, the structural bull case is, I think, undeniable. We have a decade-plus runway here. The AI capex is just astronomical. I mean, we're talking combined commitments soaring past $1 trillion from companies like OpenAI and Meta over time.
And every one of those dollars translates into construction work.
Every single one. Guaranteed work for firms like these. Then you layer on the mandatory non-deferrable grid stabilization work, plus the federal broadband push.
Yeah.
It provides a very durable floor.
But that choice between MasTec and EMCOR really highlights different risk tolerances. MasTec, with that ultra-high PE, it offers maximum breadth. But its share price is intensely sensitive to operational execution, regulatory delays like Greenlink, and those high working capital demands. It's higher volatility for higher exposure.
And EMCOR, on the other hand, that's the stability play. Lower PE, expanding margins, proven execution serving those highly capitalized hyperscalers.
But the trade-off is?
The trade-off is it's vulnerable if the tech sector, for whatever reason, dramatically slowed its data center capex cycle. It just has less diversification to fall back on.
We also need to be clear about the industry-wide risks that they both share. I mean, this renaissance isn't painless.
No, not at all. It's defined by friction. And the biggest bottleneck by far is labor. Just finding and retaining skilled electricians, welders, and engineers for these massive, complex projects. It's the _1 variable.
If you can't staff the backlog, margins erode.
They get crushed. And then there's permitting, as MasTec showed us. You can have a $17 billion backlog, but if one regional utility commission holds up a single critical segment, that revenue shifts quarters, your working capital gets stranded.
And the market just punishes that uncertainty instantly.
Immediately.
Which leads to a crucial technical observation here. Both stocks had these sharp pullbacks, like drawdowns of 13% or more in November, right?
They did, yeah. They moved away from some recent highs as the market corrected some of the froth that built up over the summer.
And that correction is key.
It is. For patient capital, that drawdown created what traders call asymmetric risk-reward. The long-term tailwinds haven't changed at all, but the entry price suddenly looks a whole lot more attractive.
So the final word is that this whole infrastructure bonanza is not fully priced in yet.
I'd say it's priced ambiguously. The recent volatility shows that. The real opportunity, I think, lies in understanding that this is a structural, decade-long re-rating of these complex engineering firms.
Firms that can handle the unprecedented dual demands of public and private capital flows.
At the same time, which is incredibly difficult.
Which brings us to the core provocative question for you to ponder. Traditional construction firms, they historically trade at really modest multiples, maybe 4 to 6 times EBITDA.
Right. Very low.
Given that MasTec and EMCOR are successfully proving they can scale to meet the simultaneous demands of the federal stimulus and the unprecedented AI power requirements over the next decade, how high can their public market multiples structurally go before the market fully realizes they aren't just construction companies anymore?
But they are essential utility enablers of the entire digital economy.
Exactly.
That is the decade-defining question for these giants.
See you all in the next Pro Ticker Deep Dive.